Hey everyone, welcome back to Corporate Decoder. Today, we're digging into Fidelity Covington Trust's latest shareholder report, and let's just say it's a deep dive into the world of their disruptive ETFs. Get ready for some serious financial decoding because we're about to uncover what's really going on behind the scenes. So what's the big story here? Fidelity has released their annual report for the period ending May 31, 2025, covering a bunch of their disruptors ETFs, think technology, medicine, automation, communications, and finance. These are funds designed to invest in companies that are shaking things up in their industries. Let's start with the flagship, the Fidelity Disruptors ETF. This report shows us how it performed over the last year from June 2024 to May 2025. First up, costs. For a hypothetical $10,000 investment, the cost here was zero. That's right, zero. This suggests a fee waiver or a very specific expense structure for this particular ETF. The big picture for the market was pretty positive. Global stocks did well thanks to a growing economy, cooling inflation, and easing monetary policies worldwide. Even with some bumps like slowing earnings growth and trade policy shifts, it was a good year for equities overall. How did our Disruptors ETF stack up? Well, it actually did better than the global index, the MSCI, All Country World Index. This outperformance came from smart choices in where to invest, particularly by putting more money into Singapore and the United States and less into Denmark. In terms of industries, they really hit it out of the park with application software. Being heavily invested there, or overweight as they say, really boosted their performance. They also did well in areas like interactive home entertainment and movies and entertainment, and even stayed away from some parts of the pharmaceutical industry that weren't performing as well. Looking at individual stocks, C was a huge win, jumping 138%. They held a lot of it, though they did trim their position by the end of the year. Another star was Netflix, up 86%, which they also reduced their stake in, but kept as a main holding. However, it wasn't all smooth sailing. Their stock picks in the US and being underweight in China actually hurt their performance compared to the index. And in specific industries, their choices in interactive media and services and how they were invested in biotechnology also pulled down their relative performance. The biggest single stock stumble was Snap, which dropped 38%. They totally sold out of this one by year end. Another significant drag was PDD Holdings, down 35%, which they also cut back on. Fundroll Accumulator Preventional T. Now let's look at the long-term picture since the fund first started on April 16, 2020. If you had invested $10,000 back then, by May 2025, your investment would have grown to $16,404. That's a pretty solid return. Compare that to the MSCI ASEAN index, which would have grown to $18,235. So the fund slightly underperformed the broad market over this entire period. Looking at average annual returns, the fund's NAV delivered 10.21% over 5 years, while the MSCI Havadul index returned 13.75%. So over the longer haul, the index has done better. But quick look at key stats. Fund size was about $90 million with only 6 holdings. That concentration means they're really betting big on a few companies. For top holdings, they were all other Fidelity ETFs focusing on disruptive themes: communications, finance, technology, medicine, and automation. This tells us the Disruptors ETF is essentially a fund of funds within Fidelity's own ecosystem. Now let's quickly check on the sisters of the Disruptors ETF. The Fidelity Disruptive Technology ETF had costs of $54 on a $10,000 investment, or 0.500T. It also saw strong gains in areas like application software and Netflix, but struggled with ASML and Marvell Technology. The Disruptive Medicine ETF faced similar headwinds, with performance hurt by Regeneron Pharmaceuticals and United Health Group. The Disruptive Automation ETF had a mixed bag, with Tesla being a top performer, but Teradyne and Renishaw causing setbacks. For communications, C was a big mover, but PDD Holdings and Snap were significant detractors. And the finance ETF saw MicroStrategy as a standout performer, while Block and Coinbase lagged. Moving on to the financials, the auditor's fees for the Fidelity Disruptors ETF were $23,800 for audits and $8,000 for tax services in 2025. For the other disruptive ETFs, audits ranged from around $32,000 to $36,900, with tax fees also being a significant chunk, around $8,200. The total non-audit fees paid to the auditors across all these related funds were quite substantial, totaling over $4.4 million for Deloitte and nearly $15 million for POC in 2025. This shows a significant reliance on external audit and accounting services. In terms of shareholder voting back in July 2024, there was a shareholder meeting. All the proposals to elect the Board of Trustees passed with overwhelming affirmative votes, typically over 96%. This indicates strong shareholder confidence in the current board leadership. The report also details the basis for approving the investment advisory contracts. Fidelity argues that the nature, extent, and quality of services provided are excellent, benchmarking their fees and expenses favorably against competitors. They also highlight the profitability for Fidelity and the benefits of economies of scale. Overall, the board found the advisory fees to be fair and reasonable, leading to contract renewals. Let's dive deeper into the financials for the Fidelity Disruptors ETF. The schedule of investment shows that domestic equity funds make up 81.2% of the assets, with international equity funds at 18.8%. You can see the top holdings are other Fidelity ETFs that align with the disruptive theme, like Disruptive Communications ETF and Disruptive Finance ETF, each making up about 21% of the fund. As of May 31, 2025, the fund's total investments were valued at about $90.5 million, with net assets of $90.2 million. That's a very tight spread, indicating good management of liabilities. Looking at the statement of operations, the fund generated about $422,000 in investment income, but operational expenses were minimal at just $403. This likely reflects fee waivers or a structure where the investment advisor covers most operational costs. The net assets at period end were $90,248,000. In the financial highlights, we see a net asset value per share of $31.95 at the end of the period. Importantly, the total return for the year was 14.68%. However, over 5 years, the fund returned 10.21% annually, falling short of the MSCI Actuary's 13.75%. This suggests that while the fund may pick winning stocks for individual years, it struggles to consistently beat the broader market over longer periods. Overall, my take on these filings is that Fidelity's disruptive ETFs are highly concentrated bets on specific themes, often by investing in other Fidelity ETFs. They aim to capitalize on major trends, and in the past year, they've had some big wins with stocks like Sea and Netflix. However, they've also had significant stumbles with companies like Snap and PDD Holdings. And crucially, over the longer term, the Disruptors ETF hasn't quite kept pace with the broader market. The minimal operational costs are notable, likely due to expense waivers, which is good for investors. But the heavy concentration in a few holdings and the fact that the main ETF is essentially a sandbox for other Fidelity ETFs makes it a high conviction, potentially high risk strategy. The direction is clear, they're betting on future disruption, but the execution and long-term market-beating performance still need a bit of proving. That's the deep dive into Fidelity's disruptive ETF reports. What do you think about their strategy and performance? Let me know in the comments below. If you found this analysis helpful, make sure to hit that like button and subscribe for more corporate breakdowns. And hey, join our Discord community linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next one.